A $680 Health Care FSA carryover in 2026 can still leave hundreds of your own pre-tax dollars exposed if your balance is higher than your employer's rule protects. So before you spend $600 at the pharmacy like you are preparing for a dramatic cold season, stop. Your FSA problem may not be a shopping problem. It may be a reimbursement problem. If your balance is $1,200 and your plan only carries over $680, the exposed $520 can still disappear. Then the next dental bill arrives and you pay with regular after-tax money like the pre-tax savings never happened. So the question is not how fast can I spend this? The better question is which real expenses can I match to this balance before a tax break turns into medical clutter? Stay with this and you will know the rescue order. Old receipts first, real care second, useful eligible supplies last. You will also know the difference between a carryover, a grace period, and a run-out deadline, because those three phrases sound similar enough to cost people real money. Take Alina, 38, in Ohio. She has 2 kids, a mortgage, and a benefits portal that looks like it was designed by a committee that deeply resented buttons. In open enrollment, she put $1,800 into her Health Care FSA because the year before had urgent care, glasses, allergy medicine, co-pays, and one dental bill with the emotional energy of a ransom note. This year was quieter. Great for her family, not great for her FSA forecast. In early December, she logs in and sees $914 left. Her employer allows carryover, but only up to the federal maximum. For 2026, that maximum is $680, so $234 is exposed. Not the whole $914, not zero. The exposed amount is $234. That detail changes the decision. If Lena thinks I have $914 to spend right now, she may panic buy glasses, cold medicine, and enough first aid supplies to stock a break room. But if she knows only $234 is at risk, she can look for old expenses first, a pediatric copay, a pharmacy receipt, or a dentist statement sitting in a portal like a refund button nobody told her to press. That is the FSA rescue sequence. Do not start with a cart, start with receipts. A healthcare FSA lowers your taxable income. In plain English, money goes into the account before federal income tax, Social Security tax, and Medicare tax take their slice. If your combined tax savings are around 25 to 35%, every eligible dollar you run through the FSA can be cheaper than paying with ordinary take-home pay. That part is useful, but the account is not yours the way a checking account is yours. A checking account does not ask whether your knee brace was bought in the correct plan year with a receipt showing the patient, item, date, merchant, and amount. An FSA is a calendar bet with paperwork attached. That is why use it or lose it is true, but way too simple. The real rule is more annoying. Use it correctly. For an eligible expense, by the correct deadline, under your employer's version of the plan, with documentation the administrator accepts, or maybe lose it. There are 3 deadline concepts that get mixed together constantly. First, the last day to incur expenses. Incur sounds like a word from a contract nobody finished reading. Simply put, it means the date you actually receive the medical service or product. A December 20 dental cleaning belongs to December. Contacts bought on January 4th do not move back into last year because you submitted the receipt quickly. Second, the run-out deadline. This one burns people because it sounds like extra spending time, but often it is not. A run-out period is usually extra time to submit claims for expenses you already incurred before the eligible spending deadline. Think of it like extra time to turn in homework after class ends, not extra time to do new homework. If your plan year ends December 31 and your run-out deadline is March 31st, that may mean you can submit a December pharmacy receipt in March. It may not mean you can buy new glasses in March using last year's FSA money. Third, the carryover or grace period rule. A healthcare FSA may let unused money move into the next plan year, but carryover is capped. For 2026, the maximum health FSA carryover is $680, up from $660 in 2025. Your employer can choose that amount, a lower amount, or no carryover. Some health FSAs use a grace period instead, giving up the 2.5 extra months to incur new eligible expenses. For a calendar year plan, that could mean March 15. Could, not must. Health FSAs generally may offer either a carryover or a grace period, not both. So when somebody says, "I have until March," the correct response is, until March for what? New expenses? old claims, or only a capped carryover. Those are not tiny technical differences. They can be the difference between rescuing $520 and donating it to the machinery of benefits administration. Do not treat the apt balance as the full answer. The app may show $914 without clearly showing that $680 is protected, $234 is exposed. Old claims can still be submitted, and some debit card purchases may still need proof. You need the plan rules. Look for the summary plan description, the FSA Administrator FAQ, the HR email, or the Benefits Portal rules page. Yes, this is boring. The point is avoiding a preventable hit. Here is the math without turning this into a tax seminar. For 2026, the Health Care FSA contribution limit is $3,400 per employee, up from $3,300 in 2025. But the carryover maximum is $680. If you elected $2,400 and have $1,200 left, the tax advantage does not protect the full $1,200. With a $680 carryover, $520 is exposed. With a $500 carryover, $700 is exposed. With no carryover or grace period, the whole balance may be on the clock. Saving 30 cents of tax on a dollar is helpful. Losing the entire dollar because you missed the plan rule is not tax planning. That is buying a discounted ticket to an avoidable mess. The FSA works best for predictable expenses: prescriptions, copays, dental work, vision care, therapy, and devices your doctor recommended. It works badly when you max it out because healthcare is expensive, which is true but not specific enough to be a claim. And do not confuse an FSA with an HSA. An HSA can carry over, potentially be invested, and follow you if you qualify. A Health Care FSA is usually more like a calendar and receipt tool. Useful, yes. Permanent, no. Now, the rescue order. Step 1 is old receipts. This is the highest quality FSA move because it turns expenses you already paid into reimbursement cash. No new spending, no guessing, no pretending a drawer full of thermometers is financial discipline. Search your email, insurer portal, pharmacy app, dentist portal, eye doctor portal, credit card history, and payment apps. Look for copays, prescriptions, dental work, eye exams, glasses, contacts, therapy, lab bills, eligible medicine, and medical devices. This is where people find money because medical spending leaves a messy paper trail. When you submit a claim, use real documentation. This is called substantiation, which is a very official word for prove it. You usually need an itemized receipt or explanation of benefits showing the date, provider or merchant, patient, service or item, and amount. A credit card charge alone may not be enough. CVS $48.32 could be eligible medicine. It could also be shampoo, candy, and batteries. The order matters. If you have a $280 dentist receipt, submit that before buying $280 of random FSA store items because a banner yelled, "Deadline approaching." A real bill you already owed is the cleanest use of FSA money. It converts trapped pre-tax dollars back into cash without creating a new purchase just to solve an old planning problem. Step 2 is real care that can reasonably happen before the deadline. Ask what you or your household already needs soon. Dental work, an eye exam, glasses, contacts, prescription refills, therapy, lab work, or medical equipment. Not, can I invent a medical shopping list because the portal is making me nervous? Call early because December turns every benefits user into a person suddenly fascinated by appointment availability. For prescriptions, ask whether a refill is allowed before the deadline. For dental work, ask whether the service can happen before the plan's last eligible date. And be careful with prepaying. If you pay in December for a service that happens later, that may not count. The plan usually cares when the service or product is provided, not when you threw a card at the problem. Step 3 is useful eligible supplies. This comes last after old receipts and real care. Build a practical list. First aid supplies you will use, a thermometer, menstrual products, saline solution, eligible pain relievers, realistic cold medicine, diabetes supplies, contact lens solution, and bandages that fit your actual life. Useful supplies can be a good final move. The problem is waste aversion. Losing $200 bothers you so much that you spend $200 on things you barely need just to avoid losing it. But the account did not save you money if it pushed you into products that expire, duplicate things you own, or sit untouched in a closet. That is just losing money with shipping confirmation. Also, be careful with FSA-eligible labels. They are helpful, not sacred. Some items need a letter of medical necessity, meaning a medical professional has to document that you need the item for a specific condition. General wellness is not always enough. Unfortunately, vibes are still not a reimbursement category. Now let's talk about employer rules, because this is where the cynicism earns its paycheck. The IRS sets maximums. Your employer chooses actual plan features within those rules. For 2026, the Health Care FSA salary reduction limit is $3,400 per employee. Employers cannot raise that above the federal maximum, but they can set lower limits, lower carryovers, no carryover, a grace period, claim deadlines, debit card rules, and documentation rules. So your coworker's plan does not save you. Your friend's employer does not save you. A social media comment does not save you. Your plan document saves you. And forfeited dollars are not as simple as the company just steals it. Cafeteria plan rules restrict how leftover amounts may be used. That does not make anyone feel better, but accuracy matters. The system is built around plan rules and not your household cash flow. That framing also helps with next year's election. The 2026 limit moved up to $3,400, which sounds like permission to contribute more. For predictable recurring medical expenses, that can help. But if your expenses are uncertain, do not let a higher limit flatter you into overfunding the account. Build the election from boring evidence. Add predictable costs first: prescriptions, copays, therapy, planned dental work, vision needs, orthodontic contracts, and supplies you reliably buy. Add a modest cushion only if your plan has a carryover or grace period you actually understand. If your plan has only a run-out period, do not treat that like extra shopping time. This is where a cash buffer matters. After-tax cash is less elegant. It also does not expire because you missed an email from the benefits administrator during the busiest month of the year. Here is the 15-minute FSA rescue checklist. First, open the FSA portal and write down your balance, plan year, last day to incur expenses, run-out deadline, and carryover or grace period rule. Not "I think," write the actual dates. Second, identify the exposed amount. If your health FSA balance is $900 and your plan allows a $680 carryover, you may have $220 that needs action. If your plan allows less, use the lower number. If there is no carryover, follow that plan's deadline. If there is a grace period, write the last day to incur new expenses. Third, search for old expenses before buying anything. Submit the largest clean claims first. Fourth, schedule real care only if you need it and the dates work. Fifth, buy eligible supplies only after the first two buckets. Sixth, keep documentation until the claim is accepted. Take a photo, save the PDF, name it something searchable like FSA Dentist December 2026 instead of IMG 9482. The goal is not to spend every FSA dollar at any cost. That is how the system tricks you into confusing activity with savings. The goal is to convert pre-tax money into expenses you truly would have paid anyway. If you use $500 of FSA money on a dental bill you already owed, that is a win. If you use $500 on random products that expire, duplicate stuff you own, or never leave the closet, that is just a different version of losing money with better packaging. Your Health Care FSA can be a solid tax tool. It can make healthcare a little less expensive in a country where one appointment can generate a provider bill, an insurance notice, a lab charge, and a mystery envelope 3 weeks later. But it is not a savings account, an investment account, your 401k, or an HSA. It is a deadline-driven benefit with rules written for plan administration, not for anyone trying to find a dentist appointment in December. So, check the balance. Find the exposed amount. Search the receipts you already have. Spend on real needs first. Use supplies as the final backup, not the opening move. And plan next year's election around actual expenses, not optimism dressed up as tax strategy. Because the worst FSA outcome is not paying for healthcare. You are probably going to do that anyway. The worst outcome is doing the responsible thing, taking less take-home pay all year, missing one technical rule, and then paying the next medical bill with after-tax cash while unused pre-tax money vanishes behind a benefits portal that still says wellness in a font nobody asked for.